Alright, hey everybody, Julian Marchese here. Today is January 22nd, and in this video I'm going to give you guys an update on my current positions and my thoughts on the market. So, as you guys know from my last video, which was I believe in December, we've had a lot of action in the global economy and therefore the markets. We saw the fiscal cliff scenario play out, which indeed had a positive reaction as the U.S. politicians in the end did make a deal, albeit with some disagreement between the two major parties, but in the end, they did make the deal, and the market had a very strong rally from the lows we made in anticipation of the fiscal cliff at 1380. The reaction we saw to 1460, which is an 80-point move in the SPOOs in about 2 days, which is absolutely massive. Since then, we have been grinding higher, kind of QE in effect style, like we were doing in the years prior, back in September to March 2010, 2011, uh, and earlier in '09 and 2010. So we're continuing to see some bullish action in the equity markets, and that's being shown especially in the Russell 2000, who has had a major move to all-time highs. We currently are sitting at all-time highs in the Russell 2000. Yields, let's take a look at fixed income. Yields have basically been flat for the past year or so. We have rallied a bit. It did rally uh, after the fiscal cliff reaction too, but not as much as equities did. So the bond market has not been expressing the bullishness that the equity market has, and most likely because of the fact that the Federal Reserve continues to uh, purchase treasuries. They actually extended QE3 to purchase treasuries, not only MBS securities. So that continues to bring a bid to the bond market. And that's been once again shown through the yields still staying pretty low. The high yield market we're seeing well, not record low yields, but we're seeing pretty low yields as of recent. New 3-year lows in yields, so 3-year highs in the high yield bond market. This is denoted by the HYG, as you can see, breaking to new highs over here. So money continues to search for yield, and that's especially being seen in the high yield debt market. And then back to the equity market here. Europe has been strong along with the United States markets. See here, I'm going to bring up Germany. This is the Germany ETF. Not as strong as the US, but still holding up. Spain has seen a massive rally from $20 to 32, which is about a 60% rise in the value of Spanish equities, and in Italian equities, we have seen a rally from 9 to about 14.5, which is once again about a 50% rally in Italian equities from the lows when Mario Draghi stated that he would do anything to save the euro at this point. So credit markets in Europe and equities alike have expressed bullishness and have been trusting Mario Draghi and the ECB at this point. My personal belief on Europe right now is that we're still in for some trouble. That doesn't necessarily mean short euro and short European, anything tied European. But I do believe that there are still a lot of more problems to come. I think the euro is the way it's built is there's many structural flaws that still need to be sorted out. And so I believe that this rally in Spanish and Italian equities that we've seen could serve to be a good shorting opportunity, and I am starting to sell into this rally, and I'm willing to sell more if we do continue to rise. I think that right now the debt ceiling is on everyone's minds. We have a potential bill tomorrow that could extend it to May which could see some more relief into the markets, more complacency. I mean, if you take a look at the VIX reaching long-term lows back to '07 lows, so you know, complacency is in the market right now. This is usually when you see some sort of turning point when the VIX becomes this low, but at the same time, the VIX can be extended and can be suppressed for quite a long period as equities continue to rally. Uh, Once again, for quite a long period, this happened before in other bull markets. So that doesn't necessarily mean go short. It just means that if there is some sort of, there's definitely tail risk going long equities right now. In other words, you're taking the risk that some sort of event will occur. In this case, everybody's watching the debt ceiling. That would cause a major reversal and expansion of volatility. So the asymmetric bet right now is to go long volatility into the debt ceiling debates, which is an inherent short position on the market. But I'm not looking to play that, as I do believe equities have more room to go higher. The U.S. has been stabilizing, so I have been looking at potentially a spread between U.S. equities and Spanish equities. This yellow line here is basically uh, the Spider ETF versus Spain. So if this is going up, if this yellow line is going up, that means U.S. equities are outperforming Spanish equities. And you can see from back to '09, '08, when this spread bottomed out, we have seen a massive rally in this spread. But at the moment, let me go back here. The moment when the ECB stepped in and decided to put a yield cap on Spanish and Italian equities, I believe those are the two, there might have been a few more countries, um, this spread collapsed and we have continued to see some declining action. So I think this has been a good pullback in the spread, and I think we're going to try and return to these highs or potentially higher. But we should see a bounce either way. I do believe after this whole United States debt ceiling debate is over with, which could be potentially sooner than April. If it gets extended, it could be sooner than April. If not, we'll have the whole politician drama into February and early March. So it could get done pretty soon. I think after that, people's focus is going to shift back to Europe. It's been a good year, or rather 8 months, 9 months since you've seen any major fears or headlines coming out of Europe, or any market reaction from that. So I think the next cycle lower in Europe is to the downside. I tend to look for opportunities that other people are not looking at, because the more people, the more important the event is. Typically, the more bets are being placed, and the more efficient the market is, as inefficient it is on the short-term horizon. So I'm trying to look for things that no one's paying attention to. And at this point, I do believe Europe is that sector right now. Everyone's looking at China starting to come out of its recent slowdown. The United States is stabilizing. We have all the fiscal drama and politician drama outside the United States, and we haven't really heard much from Europe except good news that sentiment is rising in Europe. The European banks are actually going to pay back some of the LTRO. So we've been hearing lots of good news out of Europe, but Europe once again it's the way the euro has been set up. I believe is definitely structurally flawed, with the fact that there's a monetary union, but no fiscal union. Basically, in a normal, basically capital flight, which is exactly what we've been seeing in the southern European countries, Italy, Spain, Greece, Portugal. What's happening is money is coming out of those countries, and in this case, they're all euros. And where are they going? These euros that are coming out of these southern countries are going into Germany, and France into countries in the Eurozone that are stable and or are growing. So basically, you're not seeing any devaluation of the euro. In a typical capital flight, let's say if the United States was in big trouble and people were pulling money out of the United States, what you would see is a decline in the US dollar because money's being pulled out, dollars are being sold until the US dollar devalues to a point where the United States becomes competitive again and you have an economic recovery. Essentially, in Europe, countries in trouble cannot have that same luxury of a devaluation because the money, no one's selling euros, it's just moving across the eurozone. So the euro has actually been rising, that has been hurting the southern European countries because they can't devalue their currency or their debt. Essentially, they can't monetize their debt, they can't print money, and that's hurting them with the deflationary pressures that debt restructurings and austerity has. If you can't balance out the debt restructurings and austerity with some sort of inflationary measure, which is mostly debt monetization, which those countries can't really do to the same effect that the United States can, you're in big trouble, or you're going to have it basically a prolonged economic downturn. And given if you take a look at the Spain ETF, we've gone from what here? Let's take a look at a weekly chart. $70 a share in basically early '08 to 20. That's like a 75% decline. That's depression numbers right there. Those are depression figures. It's definitely not looking good. So I think we're going to have another cycle lower, or at least some sort of pullback from a technical perspective. I highly doubt we don't see any pullback after a 60% rally. Another point that you can make with the technical perspective is we could try and rally to this trend line, and if we even try to rally up there, the higher this ETF goes, as long as Europe is not in focus, I think those are great shorting opportunities. So that's really my macro view right now. I think volatility will be suppressed into the debt ceiling. We probably will see some sort of expansion on the political drama. U.S. markets are going to be in focus, especially the Japanese right now. Huge. Well, actually, now that I looked into it, it's not too much. It's not a huge monetary program that Japan is doing, and it's only going to take into effect in 2014. But not the damage, but the expectations has been seen in the yen rally from 75 to 90, and that's pretty important because the yen is looked at as a risk-off asset, and now that money is flowing out of that risk-off, it's going to other places, specifically equities at this point. So, I think really Japan and the United States are going to be in focus for the next couple of months. Then after the whole debt ceiling debacle is cleared, Europe comes back into focus and we see further declines. So I think that's the trade over the next 3-4 months. Thanks for watching this video, guys. Hope you enjoyed it.